Hi guys, it's Stock Curry, and as the market continues to fall, small caps are starting to rise. In today's video, I'm going to tell you why now is the best time to start dollar cost averaging into small caps, and I'm going to give you the 10 best small caps to buy now. So let's get into it! Alright, the first thing that I want to do is show you this comparison chart between QQQ, which is a NASDAQ 100 ETF, and IWM, which is a Russell 2000 ETF. Now, what you're going to notice is last year, the NASDAQ as well as the S&P and Dow continued to rise all the way through December, while the Russell 2000 and small caps in general either fell or traded flat. And that is the biggest difference. Keep in mind that last year, small caps rose significantly up until about March of 2021. And then starting in April, a lot of the high growth stocks that retail investors were invested in, they started to come down significantly. And even as the small caps started to come down significantly, some of the larger caps and mid caps continued to go up, which is why we saw the Russell 2000 trade flat. Now, the other market indices, the Dow, the NASDAQ, the S&P, those are mostly made up of large cap stocks. And what we saw last year was that large cap stocks continue to rise in price and rise in value even as small caps were going down. So from March through the end of last year, small caps were dropping while large caps were rising. And what that did is it caused a lot of retail investors' portfolios to be down 60% or more while the overall market went up. So it's very important to understand that the overall market is largely controlled by large caps. Whatever the large caps do, that is what the Dow and S&P and NASDAQ are going to do because they are controlled by large cap stocks. When you look at the Russell 2000, you get a much better idea of what small caps are doing because the Russell 2000 has 2,000 stocks in it versus only 100 or 500 for the S&P, Dow, and NASDAQ. And so you get a much wider and broader range of the market index. So the Russell, as we can see, traded flat even as the NASDAQ went up. And that's what we saw last year. Now, starting in January of this year, they both went down. But I want to point out how the Russell has dropped significantly more than the NASDAQ. In fact, over the past year, the NASDAQ's only down 11%, while the Russell 2000 is down 20%. So the Russell has already fallen a lot more than the NASDAQ, meaning the Russell, once it does start to rebound, will probably rebound faster and sooner than the NASDAQ will. Now, the other thing that I want to point out is if you look at the very tail end of this one-year chart here, you'll notice how over the past few weeks, the Russell 2000 has started to trend upward while the NASDAQ has continued to trend downward. So just in the last 2 weeks, we are starting to see small cap stocks start to go up even as the overall market continues to go down. Now, this is the exact opposite of what we saw last year. Last year, from April through December, we saw the market go up even as small caps went down. But now, just over the past 2 weeks, we're starting to see a reversal in that trend, where we're starting to see small caps go up as the overall market goes down. Just like small caps were about a 9-month leading indicator to the overall bear market, this time I think small caps are going to be about a 6 to 9 month leading indicator to a market rebound. Just like last year, as small caps dropped significantly, even as the overall market went up, this year I think small caps are going to go up even as the overall market goes down. So it's a complete reversal of what happened last year. Keep in mind, small caps do not control the market. Small caps can do their own thing. So let me show you why I think small caps are very close to a bottom and they're about to start going back up. What we have here are 3 PE ratio valuations. The top one is the S&P 500 large cap stocks. The middle one is the S&P 400 mid cap stocks. And the bottom one is the S&P 600 small cap stocks. Now, what you're going to notice on the top chart, that's our large caps, is that large caps are trading at an average PE of 16.5. Now, notice how during the 2020 recession, large caps bottomed out at around 13. In 2018, large caps bottomed out at around 13 again. And in 2008, large caps bottomed out at around 9. Today, they're trading at 16.5. So it's very clear from this top chart that large caps are nowhere close to bottoming out. And large caps could fall another 50% from here before they finally bottom out. Now, because the overall market indices are controlled by large cap stocks, as large caps continue to fall, the overall market indices will continue to fall as well. However, mid caps and small caps might take a different path. If we look at the mid cap chart, that's the one in the middle, you'll see that the average PE ratio is only 12. Compare that to the large cap average PE ratio of 16.5, and 12.1 is significantly lower. Now keep in mind that during 2018, the mid caps bottomed out at 13. They're actually lower than that level today. But in 2020, mid caps bottomed out at 10, so still about a 20% drop from here. And in 2008, mid caps bottomed out at 8, which would be about a 50% drop from here. So mid caps still could fall another 20 to 50% before bottoming out, but they're certainly a lot closer to bottoming out than the large caps are. Now take a look at the bottom chart, and this is your small caps. The small cap average PE ratio is only 11.7. And if we compare that to 2018 bottom, in 2018, small caps bottomed out at 13. We're now well below that. In 2020, small caps bottomed out at 11. We're only 0.7 away, or about a 10% drop from here. And in 2008, small caps bottomed out at 10. We're only 1.7 away, or about a 17% drop from here. So as you can see, small caps are very close to bottoming out, with only about a 10 to 20% further downside potential and a much higher upside potential. That is in stark comparison to the large caps, which still have to drop about another 50% before they bottom out. Small caps are the ones that are very close to a bottom, and these are the ones that are pretty much already at a bottom. Now, I want to be very clear that I'm not trying to time the bottom here. I don't know when small caps are going to bottom out. All I know is they're currently undervalued, and they're very close to the bottoms that they hit in 2008 and 2020. So I don't know exactly when they're going to bottom out. I don't know if they're done, if they're going to fall another 10% or another 20%. But what I do know is that they're currently undervalued. Now, to be clear, what I am doing with small cap stocks is not technical trading. In fact, in today's video, I'm not going to do any technical analysis whatsoever. I am very specifically only looking at valuations. Very much so. This is a Warren Buffett style of investing, where I'm trying to find companies that are extremely undervalued, take a contrarian viewpoint, buy into these companies that are beat down and extremely undervalued, and then hold them for a big rebound up to the upside. Now, I don't know how much further they're going to fall. They could bottom out now. They could drop another 10%. They could drop another 20%. I am not trying to time the bottom. All I am doing in today's video is showing you stocks that you might want to consider dollar cost averaging into. By dollar cost averaging in, that is buying a little bit every week or every month over the next couple of years. What you're going to end up doing is you will end up buying at the bottom, but you're also going to buy a little bit above the bottom. And overall, your average is going to be as low as possible. That's what we're going for here. So I'm about to show you 10 stocks that are extremely undervalued. Keep in mind, the average PE ratio in small caps is 11.7. I'm going to show you 10 small cap stocks that are under a PE of 10. That's what we're going for here. All right, let's get into the 10 best stocks to buy now. And I do want to give 2 disclaimers real fast. The first disclaimer is this. 2 of the stocks I'm going to talk about today, I already own and have already started to dollar cost average into them. The other 8, I plan to start dollar cost averaging into this week. So I want to be very clear that all 10 of these stocks are stocks that I either currently own or I plan to open positions on this week. The second disclaimer I want to make is this. I am not a financial advisor. Nothing I talk about today is a recommendation to buy, sell, or hold. These are just my opinions, which may or may not be accurate. So please do your own research before investing in any asset. All right, let's get into the 10 best small cap stocks to buy now. All right, first up is GLDG. Now this is GoldMining Inc. Now all of the stocks I'm going to show you today, I'm showing you the weekly charts. Because these are long-term investments and we're dollar cost averaging in over many weeks and months, I think the weekly chart is the best one to show you. But again, I'm not doing any technical analysis. I'm just showing you this to give you an idea of how the stock has been trading. So on the weekly chart here, you can see that we're currently at $1.08 and we recently bottomed out at 95 cents. We also have strong support at around $1.07. Now, I'll let you know that I actually bought some GLDG about 2 weeks ago at $1.03, and I continue to buy more as time goes on. In fact, this is one I will be adding on to this week. Now, I don't want to get into GLDG too much. I'm actually going to be doing a full video on GLDG on Monday morning. So take a look Monday morning for a full update on GLDG. All right, let's get into the next one. And the next one is SoFi. This is SoFi Technologies. And I bought SoFi about 2 weeks ago at around $5 a share. I'm up about 50% on this investment already, and I continue to dollar cost average into it. Now, SoFi is the only stock on this list that does not have strong financials. SoFi is my dark horse. All of the other 9 stocks on the list have very strong balance sheets and very strong financials. SoFi is the only one that does not. But I think SoFi has enough going for it with its bank charter, with the number of products that they're offering, with their massive growth. I think SoFi has the potential to go up massively over the next couple of years. So SoFi is my dark horse. It is the only one that doesn't have a strong balance sheet, but I wanted to include it because it is one of the high growth stocks that I am investing into. It is one of the 10 small cap stocks that I have been dollar cost averaging into. So this is my dark horse. Now, GLDG and SoFi are the only 2 that I have already started a dollar cost average into. The next 8 that I'm going to talk about, I am going to open positions on this week. So let's get into them. And next up is OBE. This is Obsidian Energy. OBE has a very strong balance sheet with continually increasing revenues and good profits. Now, their earnings per share, their profits have dropped a little bit, but they're still strong. They have $4 million in cash and $77 million in accounts receivable. They have 0 short-term debt and only $3 million in long-term debt. So OBE is a very strong company. They're profitable and they have almost no debt. This is a golden stock to invest in. They should have no problem weathering a recession, and their forward PE ratio is only 4. Their current PE ratio is 1.9. So this stock is extremely undervalued. The next stock is DAC. This is Danaos Corporation. Danaos Corporation also has a strong balance sheet with continually increasing revenues, and they have continually increasing profits or earnings per share as well. DAC has $185 million in cash and $522 million in short-term investments. In total, they have $922 million in current assets. They have 0 short-term debt, although they do have $998 million in long-term debt. So their balance sheet is not quite as strong as some of the other companies we talked about. However, their profits are so strong, they will have no problem paying off their debt during a recession. DAC has a forward PE ratio of 3.17 and a current PE ratio of 1.6. This is another stock that is extremely undervalued. And if that wasn't enough, they also have a dividend yield of 3.68%. Hopefully you guys can see why I like DAC so much. Alright, the next one is one you guys have probably heard about before, and it's HIVE, or Hive Blockchain Technologies. Now, I did not like HIVE for the longest time because I always felt like it was extremely overvalued. However, with the extreme sell-off we've seen over the past few months, HIVE is now down to a valuation that I would love to buy in at. Their revenue has continuously increased every single quarter, and their profits or earnings per share is going up every quarter as well. Their balance sheet is also extremely strong, with $63 million in cash on hand, $194 million in short-term investments, 0 short-term debt, and only $30 million in long-term debt. They literally have twice as much cash on hand as they do long-term debt. So extremely strong on the balance sheet. In fact, this is probably the best balance sheet of all 10 stocks I'm going to talk about today. And amazingly, their forward PE ratio is only 2.24 with a current PE ratio of 2.35. Of all of the stocks that are on my list, I think HIVE is the most undervalued. And when I open positions this week, HIVE is going to be the largest position that I open. All right, next up is CAN, and this is Canaan Inc. And I apologize if I'm pronouncing some of these names wrong. CAN has very impressive revenue growth and equally impressive profit growth or earnings per share growth. CAN is an absolute beast on the growth spectrum. They have $422 million in cash on hand, 0 short-term debt, and 0 long-term debt. Boy, oh boy, a massive growth stock that's profitable with 0 debt. This is like a dream come true. Amazingly, their PE ratio is only 1.7. Guys, in my mind, this stock is an absolute no-brainer. This is one that I would be very comfortable loading up on. Next up is AOSL, which is Alpha and Omega. AOSL is also increasing revenues, although their revenue growth is not quite as strong as some of the other stocks on this list. They are profitable, although their profitability is kind of all over the place. It's not consistent. That said, they have been profitable every quarter. They have $323 million in cash on hand, 0 short-term debt, and only $57 million in long-term debt. So AOSL has a strong balance sheet and a decent income statement. Their forward PE ratio is 8.98 with a current PE ratio of 2.47. So not quite as undervalued as some of the other stocks on this list, but still undervalued and a good stock to invest in. Next up is RYI, or Ryerson Holding Corporation. RYI has decent revenue growth and massive earnings per share. This company is very profitable. They have $44 million in cash on hand and $788 million in accounts receivable. They also have $839 million in inventory. They have 0 short-term debt, although they do have $526 million in long-term debt. Now, this company does have significantly more debt than they have cash on hand, but since they have such a massive amount of accounts receivable, and because they are so profitable, I think it's going to be okay. Their forward PE ratio is 3.47, and their current PE ratio is 2.48. So again, very undervalued. Not a super strong balance sheet, but a very profitable company that is extremely undervalued. Next up is a stock that you may have heard of before, and that's FINV. This is Finvolution Group. FINV has some revenue growth, although it is stagnating. Their earnings per share or profitability is growing as well, although again, it's not super high growth. They have $694 million in cash on hand and $297 million in accounts receivable, for a total of about $1 billion in assets. But what really made this company stand out to me is the fact that they have 0 short-term debt and 0 long-term debt. This is a debt-free company with $1 billion in assets, and they're profitable. FINV will have no problem weathering a recession. And they are very cheap. Their forward PE ratio is 2.92 and their current PE ratio is 2.81. This is a very cheap stock that is profitable with zero debt. And did I also mention they have a dividend yield of 5.47. This would make a great stock for a dividend portfolio. And the last stock we're going to talk about today is IPI, or Intrepid Potash Incorporated. IPI has pretty decent revenue growth. They dropped a little bit, but they're still up about 46% year over year. Their profitability, or earnings per share, is kind of all over the board, but they have been profitable every quarter for the past 4 quarters. They have $60 million in cash on hand and $51 million in accounts receivable, which isn't much, but they have 0 short-term debt and 0 long-term debt. So once again, it's a profitable company with 0 debt. They have a forward PE ratio of 6.68 and a current PE ratio of 2.94. So it's not the most undervalued stock on this list, but it's still undervalued and would be great for any long-term portfolio. So there you have it, the 10 best small cap stocks to buy now. 2 of which I already own and have already started a dollar cost average into, and the other 8 that I will be opening positions on this week. I hope you guys enjoyed that video. I hope you come back and watch this video over and over again over the years. Remember, millionaires are made in bull markets, billionaires are made in bear markets. This is the time to be investing in these small cap stocks when they are extremely undervalued and very cheap. This is how Warren Buffett became a billionaire. He bought these extremely undervalued stocks. And again, I'm going to have a full update on GLDG Monday morning, so make sure you watch that video. I don't want you to miss it. And if you're looking for a broker to buy these stocks on, I want to remind you that Webull is having their 4-year anniversary right now. When you sign up for Webull using my link in the description below and deposit just $1, Webull's going to give you 6 free stocks worth up to $12,600. All you have to do is sign up using my link in the description below and deposit just $1. That's it. Now, I also wanted to let you know that if you're not a US resident and you're looking for a platform to trade on, I wanted to let you know that Interactive Brokers has some of the most discounted trading throughout the world. Interactive Brokers trading starts at just $1 US, $1 Canadian dollar, 4 euros, or 6 Australian dollars, depending upon where you live. And you can sign up for Interactive Brokers. I'll put a link for that in the description as well. Now, I do want to remind you that I have material connections for both of these. So whenever you sign up for either one, not only are you getting a great broker to trade with, you're also helping me to continue to produce these great videos for you. I hope you have a lot of success trading. Please don't forget to hit that like button and subscribe and click the bell icon if you haven't already. And I will see you Monday morning.